Stop! Don't look at this video and continue about your day if you believe that unrealized capital gains tax has no impact on the average American. Something already lost in the unrealized capital gains tax debate is the thought that this only concerns the ultra-rich and tiny little Joe Schmo taxpayers have no need to worry about it. Sound about right? Well, that is totally wrong. Today we're going to discuss the unrealized capital gains tax that has been proposed recently. Before we even get into the details, let's dispel this myth right away that the unrealized capital gains is nothing to worry about for the average person. If you truly believe that, well, I have a bridge to sell you in Brooklyn. The truth is, if you look into the history of taxation in the US, there have been countless tax proposals that started out applying only to the ultra-rich, but soon morphed into taxes generally applied to the entire population. To start with, the modern federal income taxation regime officially began in 1913 with the ratification of the 16th Amendment. According to the National Archives, due to generous exemptions and deductions, less than 1% of the population paid income taxes. Huh? Sound familiar? That sure sounds like nearly every new tax proposal that claims to affect only the ultra-rich. Look how far we have come. The federal income tax system is now a constant drag on the middle class at large in America. Once the concept of a tax on unrealized gains has entered the federal system, no doubt there will be later attempts to make it more broadly applicable to a wider swath of the population. And this brings us importantly to our next point. What really is the unrealized capital gains tax? At a basic level, this is normally presented via the following situation. Say you own 100 shares of a certain company's stock, which are worth collectively $1,000 at the time you purchase them. Let's say in 1 year, the value of the shares on the stock market have increased to $2,000. Under the current tax system, you own nothing as a result of this increase, and would only pay a tax on the gain if you sold the stock and collected your $2,000. Under the proposed unrealized capital gains tax, you would be required to pay tax on the appreciation in value of the stock even if you did not sell it. So this would be like paying a type of rental fee to continue owning your stocks. Sounds simple, right? Well, here is where the whole proposal goes horribly wrong. The first major problem is that the proposals put forward do not limit consideration of unrealized capital gains to only stocks. You know what else can experience capital gains? That's right. Real estate, investments in private businesses, vehicles, art collections, and on and on. Now, what happens with this situation? Who figures out the valuation fluctuations of all of these assets throughout the year? Does the government pay an army of auditors to work with the individual taxpayers? Are the taxpayers forced to cover the cost? Does a cottage industry arise of evaluating the cost of all assets every year? The answer is likely a mix of the above, which all result in a downward pull on the effectiveness of the tax. In fact, we know how difficult this administration hurdle can be, based on historical examples in other countries. France had a long-standing wealth tax that was in place for many years, and most recently abolished in 2018, because it was so difficult to implement and fell far short of its expected impact. Do you believe that a socialistic government like that of France really wants to protect its millionaires and billionaires more than does the US? I don't think so. Once the unrealized capital gains tax fails at achieving its collection goals among the super wealthy for various reasons, it will again fall as a new tax burden to the middle class. Herein lies another major piece of misinformation that has already been floated to the American taxpayer. Pundits say, there already is an unrealized capital gains tax in the form of property taxes. However, this is disingenuous in at least two ways. First, as any homeowner will immediately tell you, the assessment of a home's value for property taxes is not a regular phenomenon in many states. For example, in Pennsylvania, many counties assess only once per 20 to 25 years, leading to a status quo where property tax assessments typically lag far behind the true property value that may be calculated. This makes sense at a certain level. If counties reassess tax too frequently, driving up tax payments, homeowners are free to sell and move to lesser taxed counties, resulting in overall tax revenue reductions for higher-priced counties. So this concept of having to reassess valuations on a yearly basis would be totally foreign to most taxpayers. Furthermore, the amounts discussed as part of the unrealized capital gains tax of 25% is totally out of proportion to anything remotely close to property taxes on real estate. Nationwide, the average tax rate is closer to 1%. And in reality, property taxes are used to cover local expenses such as schools, roads, first responders, and typical municipal infrastructure that is not supported by the federal taxation system. Therefore, trying to pull the wool over Americans' eyes by claiming an unrealized capital gains tax is just like property taxes is really disingenuous. It would be a new tax to continue funding new spending by the federal government. One major oversight not yet covered in the national discourse is that a very obvious potential negative side effect to entry of the unrealized capital gains tax is a disincentive toward investment. Think about it this way. What's one obvious way of avoiding capital gains? Well, it would be to simply own fewer assets capable of incurring a capital gain. Say you decided to hold $1,000 in cash instead of owning $1,000 in stocks. If I'm going to take the risk of providing other companies with my hard-earned money to grow the economy, why am I going to risk a significant confiscation of my possible rewards? I could just keep it in cash instead. What's the proposal once that starts happening nationwide in the US? Taxation of cash in bank accounts just for sitting there? Negative interest rates? If you have been closely following the Japanese economy recently, you will quickly see how disastrous this can be. Thanks for watching this video. For more tax and business-related videos, please like and subscribe.